In this video, I'm going to teach you what the banks do, not what they say. And by learning this strategy, you may save tens or perhaps even hundreds of thousands of dollars in interest and pay your mortgage off years earlier. The best part? You will not have to pay out any additional funds to accomplish this. Over the years, I've watched numerous videos on how to pay your mortgage off years earlier, and most of them have two common themes. One, a reliance on strict discipline, and two, the commitment to make extra payments by either increasing payment frequency, payment amount, or refinancing to a lower interest rate while keeping the same terms on the mortgage. Let's talk about these issues with these two common themes. First, let's talk about relying on strict discipline to pay off your mortgage sooner. What this often means is having the discipline to cut back on any expenses that are not completely necessary, such as cable, Netflix, eating out, Prime, new clothes, vehicles, gym memberships, and then taking those extra funds and placing them against your mortgage principal. Sure, that will definitely work, but it will take often unreasonable discipline. And do you really want to endure hardship and give up all of life's little pleasures simply to give money to the bank faster? The second common theme in most videos on how to pay off your mortgage sooner is having the commitment to make extra mortgage payments. Well, it isn't that difficult to accelerate paying off your mortgage if you have a high disposable income and are disciplined enough to direct extra payments against your mortgage principal. But the question is, do you have extra funds to throw at your mortgage? A recent survey found that 53% of Canadians are within $200 of not being able to cover their bills and debt payments. What if you, like most people, are living paycheck to paycheck and struggling to make ends meet? The average homeowner not only has mortgage payments, but credit card debt and consumer loans as well. In fact, the average individual debt, excluding mortgages, is $22,000. For many, making additional mortgage payments is likely out of the question. If this describes your situation, then you need to learn my mortgage pension strategy. With my strategy, I'm not asking you to make any additional payments. I know that most of us can't afford to. I am asking you to have an open mind as I create a paradigm shift in how you look at the financial world, and most important, how it can benefit you. Have you heard the term OPM? It stands for other people's money. Financial experts for years have taught the strategy of using other people's money as a blueprint for creating wealth, because it's nearly impossible to become financially free with personal savings alone. Well, there is a business that has perfected the concept of using OPM to create wealth. It's called a bank. That's right, banks. What does a bank do? A bank takes money from depositors, promises them a return on their investment, usually a small return like 0.5% or 1%. What does a bank do with those funds? They loan them out. They lend the money out in mortgages, other personal or business loans, and then they charge a higher interest on those loans than they pay to the depositors. Well, whose money is it really? In the case of mortgages, perhaps 3%, or in the case of a car loan, 6% or more, and they collect the interest on the loan from the borrower, pay the depositor their promised interest, and they keep the difference for themselves, and that's called a spread. Banks run a great business. They use OPM to create wealth. They tell us to keep our money safe by depositing in savings accounts or term deposits, and then they turn around and invest those same funds into loans that pay more interest than they're required to pay out. Well, that's a brilliant business model. And they make huge profits with little risk. They use OPM. They use other people's money to invest, keep the spread as profit. Well, what we really need to do is act like a bank. Do what they do, not what they tell us to do. The question is how? Well, when you bought your house, you combined your down payment with a mortgage. You promised to pay the bank back over 25 or 30 years with a blended mortgage payment. That is a combination of principal and interest. Let's ask, what do the banks do? The bank plays the role of facilitator, taking the interest from the borrower and paying interest to the depositor, and they keep the spread for their profit. And boy, do they ever make profit. In a perfect world, the bank's perfect world that is, the depositor would never ask for their money back and the borrower would never pay the money back. Is it possible for you and me to do the same? Absolutely. I use OPM to buy my house. That's mortgage bank depositors, and I agree to pay the interest on that mortgage, but that's all I pay. Why would I choose to do this? I take the money that normally would go toward the mortgage payment, the principal payment, and instead I invest it into mortgages just like the bank. I invest in private mortgages that pay considerably higher interest rates than a bank. I only invest with companies that have a long track record of consistent profits with no loss of investors' funds. That way, I can confidently make spread or profit from other people's money. Before I continue, I want to make it clear that I live in Canada and the products I use are available in Canada. I am sure that identical products are available in other countries as well, but you may need to do a little research before you implement the mortgage pension strategy. Well, I use 3 products for my mortgage pension strategy. The first one is a mortgage that allows me to pay simple interest only. That means I'm not required to pay any mortgage principal payments. Instead of paying back the mortgage principal, I invest the funds into a tax-free savings account that compounds my earnings tax-free. One of the main investments I use in my tax-free savings account is number 3, a mortgage investment corporation, or MIC, that invests in private mortgages. Do you understand how the strategy works? I'm not paying any additional funds toward the mortgage principal, or I'm not cutting back on any current expenses. The mortgage principal does not reduce like a traditional mortgage. Rather, the principal payment is directed to my compounding tax-free investment account. Effectively, I'm borrowing at 3% simple interest and I'm earning 9% compound interest. For most people using my strategy, the investment account may, in time, equal the outstanding mortgage principal, and at that point, they can choose to pay off the mortgage in full. Let's look at an example of how this works. Let's look at a typical family. Home value $700,000, a mortgage of $300,000. They have a monthly payment of $1,400. Credit card debt of $15,000 with a monthly payment of $450. Vehicle loan of $7,000 and monthly payment of $400. For total monthly payments of $2,250. Let's combine the debt into an interest-only mortgage. So the debt will remain the same at $222,000. Interest-only payments at 3% are approximately $800 a month. So the total current payment of $2,250, you pay the interest only on mortgage of $800, invest the difference of $1,450 into the TFSA account that will compound tax-free. So let's assume the current deposits on the TFSA are 0. You're going to put a monthly deposit of $1,450. The annual return is 9%, and it is compounding 4 times annually. So the current maximum deposit into TFSA is $6,000 annually. Assume the couple max out at $12,000, plus they're going to use previously unused room. So in the first year, they will accumulate $18,136. In year 2, $37,973. In year 3, $59,671. Well, let's forward on as we keep going and investing monthly on an annual basis. So by the time we get up to 7 years, we've accumulated $168,819. By 9 years, we're up to $239,951. And by 11 years, we are up to $325,054, which is equivalent to your mortgage principal. Now, you can actually pay your mortgage off 14 years early without changing any current payment structure. I have included a link to a compound interest calculator on my website, mortgagepension.com. Put your own numbers into the calculator and see how your particular circumstances will play out. Check out some of my other videos, and if you found this video beneficial, please consider subscribing to my channel and hit the like button. Thank you for watching.